Insurance isn't one size fits all. That's why drivers have enjoyed Progressive's Name Your Price tool for years now. With the Name Your Price tool, you tell them what you want to pay, and they'll show you options that fit your budget. So whether you're picking out your first policy or just looking for something that works better for you and your family, they make it easy to see your options. Visit Progressive.com. Find a rate that works for you with the Name Your Price tool. Progressive Casualty Insurance Company and Affiliates. Price and coverage match limited by state law.
This episode is brought to you by Indeed. Stop waiting around for the perfect candidate. Instead, use Indeed sponsored jobs to find the right people with the right skills fast. It's a simple way to make sure your listing is the first candidates see. According to Indeed data, sponsored jobs have 4 times more applicants than non-sponsored jobs. So go build your dream team today with Indeed. Get a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
We are back! We are back! We are getting Doug back!
And we're the 3 best friends that anybody could have. We're the 3 best friends that anyone could have. We're the 3 best friends that anyone could have. And we'll never, ever, 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 ever leave each other. We're the best 3 friends that...
Live from Joe's mom's basement, it's the Stacking Benjamin Show. I'm Joe's mom's neighbor, Doug, and one big mutual fund company is in the news. Is it Vanguard? Maybe. On today's show, we'll share lessons about target date funds, tax planning, retirement planning, and switching accounts. And in our TikTok Minute, one mom finds out she's apparently way more wealthy than she ever thought. Plus, we'll answer a question from one stacker who thought, I'd better call Saul. See hi and OG with my question about tax optimization. Great thought, stacker. And you know what else is great? A scoop of my world-famous trivia, that's what. And now, 2 guys who want you to have enough money to live your dreams and still buy popcorn at the movies. It's Joe and OG. Joe, nobody goes to the movies anymore and buys popcorn.
You know how great it is, first of all, to escape to a movie theater for a couple hours. It is just amazing. But second, imagine buying popcorn, like seriously, and not having to refinance your house. I mean, how wealthy are you, Doug?
You know who else tried to escape to a movie theater? Lee Harvey Oswald, Joe.
Did he?
Too soon?
Is that a fact?
Yeah, that's where they caught him.
What was it? Was it really?
Yeah.
Wow. Hey, everybody, welcome to Trivia Joe Didn't Know for the win.
Joe, do you get the large popcorn at the Cinemark, or do you get the small with the free refill?
There is no, see, at our Cinemark, you have to get the large to get the free refill.
So what do you do?
I just get the small now. Because I will eat the large and then I will feel ashamed of myself the rest of the day.
Very salty for the rest of the week.
Incredibly salty. Oh, such a great Wednesday. Welcome to the Stacking Benjamin Show. And we're super happy you're here. We've got a potpourri of exciting topics today, an amazing headline. And Doug, it looks like we've got an action-packed agenda looking at all the stuff going on today.
The schedule. We're
going to teach people a ton about your money and about investing, which I know is a lot of our stackers' favorite topic to talk about that. OG, having a good midweek today?
Oh, yeah. It's fantastic.
Is there a specific reason why, or is it just because you're here with us?
Oh, I believe it is because I'm here with you.
There you go.
That's what the cue card says here. And
we're not sure yet, but it could maybe be because I'm here with you guys. Get back to me on that.
We're about to find out in the next hour, Joe, whether I like it here or not. All right. One big mutual fund company in the news. We're going to get to them next with our headline. But before that, we have a couple of sponsors who make sure that we can keep on keeping on and you don't have to pay anything for this goodness. So let's hear from them and then into a boo-boo from a big mutual fund company. Dell PCs with Intel Inside are built for the moments you plan and the ones you don't. They're for those all-night study sessions, the moment you're working from a cafe and realize every outlet's taken, the times you're deep in your flow and can't be interrupted by an auto update. That's why Dell builds tech that adapts to you. built with long-lasting batteries so you're not scrambling for an outlet, and built-in intelligence that makes updates around your schedule, not in the middle of it. Find technology built for the way you work at Dell.com/Dell PCs. Built for you. In business, there is no room for guesswork. Every shipment matters. Every deadline counts. And when you're trying to keep operations running smoothly, the last thing you need is uncertainty. That's why reliability is at the core of USPS Ground Advantage. From the moment your package is first scanned in, it moves through a secure nationwide network, aiding in a timely and accurate delivery. You get near real-time tracking so you can keep up with your shipments. And with affordable upfront pricing, there are no hidden fees or surprise surcharges to throw off your cost sheets. It all adds up to predictable deliveries you can depend on, because knowing your logistics are handled lets you focus on everything else, your customers, your team, and the future you're building. Visit USPS.com/Ground Advantage to start shipping with confidence. USPS Ground Advantage. We mean business.
Hello, darlings. And now it's time for your favorite part of the show, our Stacking Benjamin's headlines.
Our headlines today comes to us from investmentnews.com. This is a website for industry insiders. We like it if you're new to the Stacking Benjamin show, because here they often talk about lots of topics that are a little different than what I see in most of the things that are in the popular press. It's really what the pros are worried about. And apparently what the pros are worried about right now is a little company called Vanguard, OG, because Vanguard getting their hand slapped by the SEC. This is written by Leo
Tolstoy.
DiCaprio.
Almanzora. It's probably a cousin.
So close.
Of those people. Just a bit outside, to quote Bob Uecker. Oh my God, that guy was funny. His sense of humor. Bob Uecker died, 2 weeks ago? Just fantastic.
Article, Joe. Article.
Fantastic sense of humor. Anyway.
Tried the corner and missed.
Just a bit outside. Vanguard set to pay $106.41 million to settle charges from the Securities and Exchange Commission for reportedly making misleading statements regarding its target date retirement funds. Now, Vanguard, not a company where we've had, I can't remember us ever having a Vanguard headline like this. In an order published last Friday, the SEC said Vanguard misled investors with respect to capital gains distributions and resulting tax consequences for retail investors who held those target retirement funds in taxable accounts. So this is what happened, OG. This is also what happens when you are a company that is the low-cost provider. You attract a lot of people who are very naturally fee adverse. And the second that you offer something with an even lower fee, people tend to go that way. Here's what happened. Vanguard in December 2020 decided to lower the minimum investment for its institutional target date retirement funds from $100 million to $5 million. So now if you've got $5 million, you can go into the institutional one. Of course, the institutional target date retirement fund has a lower fee than the investor class.
Retail version, right?
Yeah, target retirement fund. So because it had lower expenses, people moved out of the retail version and into the institutional version. To meet the demand from redeeming investors, the SEC said Vanguard's investor target date funds then had to sell underlying assets that had appreciated in value. The retail investors who stayed in the funds and held shares in taxable accounts, bam, they were effectively punished because Vanguard lower.
Because the people left. The people who stayed were left holding the bag.
Left holding it.
As it were.
There is a lot to unpack here. I want to talk about all these things. But first of all, let's talk about how mutual funds tax people so we can understand why this is a big deal. Because if you're out there maybe buying a mutual fund and it's not inside of a retirement account, OG, you might be caught, maybe not in this situation, but you may be caught wondering, why do I have to pay tax when I didn't sell anything?
Yeah. Mutual funds don't tax people. The government taxes people, but the mutual funds have taxable events within them, right? And that's the struggle bus. I remember Joe, you and I have a friend at Ameriprise from our Ameriprise days who had inherited a relationship. It was, an advisor who had retired or somebody who had left the firm, and this person inherited this account and was super excited by it because it was a big number. It was a $700,000 account. It was in one mutual fund, and then that year, that mutual fund had a 50% capital gain distribution.
Oh, man.
And you go, well, what the heck does that mean? That means that this person had on their tax forms, it's as if they sold $350,000 of gain. It's as if they had $350,000 of gain on their tax form. And so the way that this works inside of a mutual fund is that there's all the different stock holdings, and the mutual fund owner or the mutual fund manager is buying and selling and rebalancing and that sort of thing with maybe an eye toward taxes or maybe not. It depends on, what their stated goal is. But their main objective is whatever their main objective is, capital appreciation or dividends or whatever they say it is. And every time that there's a transaction inside of a mutual fund, that's a taxable event, just like it is in your investment account. If you buy Apple and then sell it, it's a taxable event. Either that's a tax gain or a tax loss, and you aggregate those at the end of the year. And the same thing happens in a mutual fund. All that stuff happens throughout the year, and then at the end of the year, they aggregate it all up and go, well, how much did we have in gains or losses? In a perfect world, it kind of nets out to even. In years where the market is skyrocketing and going gangbusters or whatever, sometimes there's a gain, and then they just distribute that. They say, well, we made $100 million. We have 100 million shareholders. Everybody's getting $1 of capital gains, and it's just assigned to you. So you just get a tax form that says, oh, by the way, you made $1 or you made $1,000, or in this lady's case, $350,000, even though you didn't do anything. It's because of the stuff inside of it. The other complication is it's indiscriminate in its assigning. It's literally whoever owns it the day that they assign it.
This
you
is
say,
the
well,
tough
I just
part.
bought it yesterday.
Right.
You go, yeah, we don't care. You have it today. You're in the club. Welcome to the club. You're paying the tax. You're part of the organization here. So if you're going to invest in money in a mutual fund and you're getting toward the end of the year, it's one of the steps that you have to take of paying attention to when are those capital gain distributions being issued, and do I want to be a part of it? Is it a big enough deal for me to pay attention to that? And I've seen people get burned by that too. Put in bonus at the end of the year. They get their bonus and they go, let's invest the money, and they invest it, and you go, wait a second, I had this fund for 5 minutes and I'm paying $10,000 in taxes. What the heck?
What happened?
Yeah. Welcome to the party, pal.
The good news is this information, if you know to look for it, is all public record. And if I remember right, it comes out generally about a month before the day that they're going to have the capital gains distribution date. Is that about right?
Yeah, I think, most companies try to get it wrapped up by the middle of December. So sometime around Thanksgiving, or maybe even earlier than that, they send an estimate, right? Because there's still trading that's happening between, the time that they issue the publication and beyond. And if it's a big enough trade, if you're going to say, hey, I'm going to go buy $1 million worth of this mutual fund, I would get on the phone with the fund company and say, I'm about to buy $1 million worth of your thing. Is there anything I should be aware of? They'll say, oh, you might want to hold off till December 19th instead of buying at the 17th.
Well, and on the other side, if you are thinking about selling the fund and you're fairly certain you're going to sell the fund and it's not inside an IRA and they're going to have some type of capital gains distribution, some distribution that comes out, sell it before that day. Like don't stay on the hook for capital gains tax for that year. I think this might be just a problem of the fact that because mutual fund architecture sold is from the 1940s, a much more tax efficient way to go then would be an exchange traded fund, because exchange traded funds, OG, will avoid a lot of these issues because you directly own a share like you own a share of stock.
I mean, it avoids all of those issues, but it picks up other issues. It's not a
get out of jail
thing
free.
That you can just go, this is a free way to do it. It's an unknown. It's very behind the scenes, and it's very 201, 301 in terms of the bid-ask spread. We talked about this before. The bid-ask spread. You're doing what?
That's a bid-ask spread.
Hey-oh.
It's really the price that you see quoted versus the price that you get filled at. And for most people, we just don't pay attention to that or care about it. And honestly, it's probably an insignificant amount, but it's not zero. It's the difference between could be a few pennies or a few dimes for most people, but it's not zero. And so that's really the trade-off is it better to have the tax bill of the mutual fund or the spread risk of ETFs since most people don't pay attention to that, honestly, and it's like a internal tax versus an external tax, so to speak.
Yeah.
I think most people would be okay with the fact of paying the thing that they don't know that they're paying because they just went online and said, buy me 100 shares of SPY and life is good.
I had to warn Mom about that when we bought shares about a month ago. I told her, I said, the second we buy this, it's going to look like we lost money. Just so you know, the second we buy it, it's going to look like we lost money. And sure enough, it
doesn't look like you lost money. You lost money.
You lost money.
That second you
Good
did.
Point.
Yeah. Correct.
The second you purchase, you're like, what happened there? Yeah, I lost some money. Where did that go? Oh, the brokerage firm kept it.
Yeah. Ether. It went into that's your mutual fund tax that you didn't pay. Mm-hmm.
There it is. So that is problem number one that Vanguard ran into. Just to go back through this, maybe a little bit in slow motion. Vanguard allows people into a cheaper share class of this mutual fund. Investors already paying, oh gee, by the way, very little, just paying very little, but they're like, heck, if I could pay less, I'm going to sell this and I'm then going to buy this other fund that costs less. Those people had a tax on their end, right? I mean, if they'd held it for a while, OG, they're still going to have to pay a tax for the thing that they did. If it's in a non-IRA account, just a regular brokerage account.
Yeah. The people who move from the higher cost to lower cost, you're saying?
Yeah.
At a taxable event of selling the thing. Yeah, quite possibly that's the case. I don't know if this is the case in this circumstance. Sometimes by changing share classes, they don't make that a taxable event. I don't know how Vanguard did it in this case, but it sounds like the vast majority of the situation was because of the fact that they the rich got richer in this case.
Yeah, like, you would expect
left all the pain with the people left over, all those poor people with under 5 million.
Under 5 billion. You would have expected that those people would have a tax. So the surprise was because they had to sell a bunch of stuff internally, even though you didn't sell, you ended up with a tax. There's another thing here, which is it's a target date fund. Because it's a target date fund, OG, there's several different funds inside of this one fund, which also is something I know that you and I talked about before. We really don't love this architecture of the target date fund, like having all these funds mixed up in one place. You want to dive into that for a moment?
Well, the major issue with target date funds is, generally speaking, you're adding a layer of complexity on top of your asset allocation for no discernible benefit. I don't know that the allocation is correct or incorrect, and I don't really care. But the major problem that I have with it is twofold, which is to have somebody package it together for you is going to cost extra. It's the buying a watermelon at the store or buying a watermelon that's all sliced up in a Tupperware. You know, you go look at the insane difference in price of buying the whole thing or having someone package it for you. It's like a watermelon's $1, or you can get a couple of slices of watermelon for $3.50.
It's an oddly specific example he just chose, Joe.
This is, by the way, Len Penzo's favorite thing to rail against. He's like, the cost to slice up a mushroom.
Yeah, exactly. So, there's always going to be an extra layer of cost there. So for everybody who's goo goo gaga over fees, it's like, why the hell would you pay an extra whatever to have somebody slice up the fruit for you, you jackwagon? Do it yourself.
Well, jackwagon. A little anger in there. Is there also, do they tend to be a little more conservative than necessary or a little more aggressive than necessary? Is that another downside?
Yeah. I mean, so the first thing was the packaging. And the second piece is you end up on this glide slope of conservativeness that ends way too early. And it's somebody else's schedule. And the idea is, this fallacy I think people have. I had a conversation with somebody this week that he was, a young guy. And he's like, well, when should I get conservative in my portfolio? I'm going, what are you talking about? Never. Why would you want to? And I'm going to keep on beating that drum until we get rid of fixed income as an asset class for the mainstream America, because you're purposefully putting an anchor in your portfolio to slow down the growth of your account. I don't understand why you would do that. And especially I don't understand why the hell you would do it starting at 45 or 50. Oh, thank God, I finally got enough money that's going to start compounding. Let me stop compounding it. That doesn't make any sense to me. And I understand people say, well, you got to be conservative when you get to retirement. No, you need to have liquidity for the first year or two to avoid any major meltdowns in the market, the unlucky phase of retiring. The guy or gal who retired January 1st of 2008 was unlucky in their timing, right? You didn't know on January 1 that the world was going to implode in a gigantic recession for 3 years, but having cash on hand to withstand that would have been okay, because then the market recovered. You know, the S&P in March of 2009 was 650. 6,000 now. It's freaking 10 times. Like, why would you have any interest in letting off the gas if you've already seen this happen in your lifetime, you know, that it's 10x twice? Why would you go, well, I don't want to do that anymore? That was, I'm good. I don't need to do that. So target date funds tend to get conservative early and then, you know, drive you into this ultra conservative portfolio right when you need to be having that, like we like to call it, that final double, that last chance that you have to have your money grow one more time, to do that one more compound from 53 to 60. You go, all right, this is the final multiplier before I'm gone. And Vanguard and all these other places go, now you're good. Just let off the gas.
I think part of the reason that they're overly conservative as well is kind of like what we're reporting on here. Vanguard, OG, gets this huge settlement for something that appears to me on the outside to be an unintended consequence, right? Just a complete unintended consequence of trying to allow people to do a less expensive option. I mean, think about this. Vanguard's like, hey, let's let more people do the not as expensive thing. Okay. Here's $100 million.
I mean, I don't know that that's the reason the conservative target date thing happens. I think it's more of a cultural, you know, relic from something from some time ago where people said you have to be bonds minus your age. And this is still hanging on despite all of the evidence to the contrary. And it for as much as I'm concerned about, you know, the youth as it relates to market corrections and the fact that they haven't really seen any in their lifetimes, and when they do, they're going to puke, any significant ones anyway, I'm still flabbergasted by the fact that people will have seen what they've seen over the last 15 years of their investing lives and go, yeah, I should be conservative, right? It's like, if nothing else you've learned, don't be conservative. Like that I would think would be the message that people have learned over the last 15 years is, why would I invest in anything other than the equity and ownership of the biggest companies in the universe? Despite seeing that, people go, well, I'm close to retirement. I should start being conservative now. Don't do that.
I had a great meeting with a stacker last week who was talking about the fact that she hadn't really considered enough that retirement, to state one big goal people have, is not an event. It's still going to be X number of years of your life. And I think everybody thinks, okay,
maybe a third of it if you're lucky.
Yeah, I got to get conservative when I hit that number. No, you need some money where you can get at it, but you still have this money you need as a growth engine for those later years.
I mean, I think about it even in a bigger picture, which is you get to age 60, you've got $3 million in your account. You're like, okay, cool. 4% rule, 10,000 a month. I'm going to be great. Like, that's all good and grand and wonderful and all, but you know, that 10,000 has to grow with inflation, right? It's not 10,000 for the rest of your life. So you need to make sure your money's in a place that's going to grow with inflation. And secondarily, you're finally at a place where like you're seeing some major increases in your portfolio year after year after year. And think about the next generation or the second generation, not maybe your kids, but your kids' kids. And the fact that they have a 60-year time horizon or 80-year time horizon before your kids' kids need the money. Like your grandkid, when you're 60, how old are your grandkids? 5? Like they have a 60-year time horizon. Like, my God almighty, like invest in the future. You have 60 effing years for your grandkids. Imagine if grandma and grandpa would have put $3 million in an account for you. How much would that be worth? What was the S&P at 50 years ago?
This is when
I get the S&P at when you were born.
Yeah, this is when
God almighty.
When I roll my eyes a little bit as well is when I hear about people saying, well, you know, if you're 75 years old, you shouldn't be in growth stocks. And I think, well, if you start off with what the money's for, to your point, if it's not for
your family, you will be.
Absolutely. If it's not for you, if it's for your family, for the wealth of the people after you, then hell yeah, you want to be in growth stocks when you're 75.
And for you, because at 75, you still need money when you're 85 and 95, probably, statistically. So you need it for you, but you damn sure need it for your kids and grandkids.
The thing people are worried about in a growth stock is the higher likelihood of the crash when you're 85 and you need that money and you don't think you can withstand the $50,000 hit because that growth index just crashed. That's what I think people are worried about.
I mean, that's why you start off with, when am I going to spend the dollar, right? And you work backwards. This is why you start off with the date that I'm going to need the dollar and then go back. That's how you mitigate that risk.
And I think there's a second piece to that, which is when you retire, let's say you're 65 and you're financially independent and you're good, right? You're not great, but you're good. You're the proverbial 4%er. You got your 2 million, you're going to take 80 grand, that sort of thing. You're in that area where, to your point, Doug, if the market does go down 30% and you're all in stock, you're going to feel pretty freaked out. Your 2 million turns into 1.2 in a hurry. And you're like, whoa. You have to have an insane faith in the future that it's going to be okay. But the corollary to that, the opposite, I think, that the effect of that happens is that if you do the right thing when you're 65 and that money doubles twice by the time you're 85, and now you have $8 million and you're still managing your lifestyle, you're living your life, you're doing your thing, you're so far ahead of the curve at that point that it doesn't matter what happens. Like, if the market goes down 30% and you have $8 million and you're spending $100,000, $200,000 a year, you have so much excess. We call it margin of safety. You have so much margin of safety, it doesn't matter. And that's really the goal, is to kind of get through that surf zone, that little bit of time where being unlucky will affect you. And there's no way to predict that. There's no way to know that you're the January 1st, 2008 guy or gal. It just is unlucky. So the way to protect against it, or to Joe's point, to mitigate that, is to say, I need to have 2 years worth of cash available in case I have a 20% decline. If early on I got a 20% decline, I got to live on my cash for 2 years and let my portfolio do its thing. I got to be okay with it going from 2 million down to 1.2 and let it ride and let it get back to 2 million, because eventually it will. And I just have to give it time. And if you're unlucky and that happens to you early, so be it. You've got the cash to support it. If you're lucky and it doesn't happen until year 10 or 15, you have so much freaking money. You're so far above that glide slope, that margin of safety, that 20%, 30%, 50%, look, who cares? It sucks. If you have $4 million and it turns into 2, you're not going to be excited. You're not going to have a happy day. But from a financial standpoint, you're okay. So that's really what you have to mitigate, is that first 3 years or 5 years of being unlucky.
I want to backtrack too, OG, to one other thing you said, which is the target date fund adds a layer of complexity, which I know a lot of people think that adding a target date fund makes things easier, right? It's easy. Oh, I'm just going to let somebody else handle it. But there truly is so much going on under the hood that you don't understand. I think you're proving to yourself that I'm not smart enough. I don't understand how this works. And if you can take half an hour or an hour figuring out how this works, and you don't have the target date fund, your plan becomes stickier and you're much less likely to bail on it when things go poorly. I do not like these magic solutions. I get tired of hearing people go, oh, which Merriman portfolio do I pick? Why am I picking this magic portfolio with this magic person? Do I pick a Rick Ferry portfolio? What's a portfolio that I pick? The second that you think somebody's a magician and it doesn't go the way that you want, because you don't understand what the hell Rick Ferry's doing under the hood or Paul Merriman's doing under the hood, you're more likely to bail. It drives me crazy when we do that. And we do the same thing with target date funds on a much, much bigger level, right? So whether you're a nerd or somebody that starts out and thinks that you're not smart enough, yes, you are. You're way smart enough. And I think it is
Stuart
far
Smalley,
more complex.
man. You're good enough. You're
Damn
smart
it.
enough. And doggone
people
it,
like
people
you.
like you.
Absolutely. All right, we'll dive into more on this topic. I love this headline because of all the different areas we covered. I mean, we talked about diversification, getting a little bit under the hood. We talked about tax implications of mutual funds and exchange traded funds. There's so much here in just one seemingly simple headline that I really like. We'll link to it in our show notes at stackybenjamins.com if you want to read it for yourself. In just a moment, we are going to have our TikTok minute, and we'll answer a call from a stacker who's wondering about tax optimization. We're going to do all that.
Don't buy Vanguard
funds.
Doug's.
There's our lesson. Doug's got, in this case, no, apparently. Doug's got some trivia, though. Doug, what's on tap today?
Hey Hey there, stackers. I'm Joe's mom's neighbor, Doug, and it's Oprah Winfrey's birthday today. You know what that means? You get a car, and you get a car, and you get a car. Wait, hold. Okay, sorry, I did that wrong. I mean, I wasn't promising cars to both of our stackers. I was just doing the whole Oprah thingy where she says never mind. On today's date, speaking of cars, a Mannheim, Germany-based car creator patented his first successful gasoline-driven automobile engine on today's date way back in 1886. Here's the question. What was his name? I'll be back right after I go fill up OG's Mercedes with fuel. That should make him less grumpy. Yeah, right.
You're listening to this podcast, so I know you've got a curious mind. Here's a helpful fact you may not know yet. Drivers who switch and save with Progressive save over $900 on average. Pop over to Progressive.com, answer some questions, and you'll get a quick quote with discounts that are easy to come by. In fact, 99% of their auto customers earn at least one discount. Visit Progressive.com and see if you can enjoy a little cash back. Progressive Casualty Insurance Company and Affiliates. National average 12-month savings of $946 by new customers surveyed who saved with Progressive between June 2024 and May 2025. Potential savings will vary.
What would you do if your online store converted 36% more shoppers? You could take 36% more vacation.
Another pina colada?
Yes, please.
Open a new retail location with 36% more square feet.
Fantastic.
Hire 36% more help.
You're hired and you're hired.
Shopify has the world's best converting checkout, up to 36% better than other e-commerce platforms. What you do with those extra sales is up to you. Switch to Shopify today at shopify.com/listen and get a $1 trial. Shopify.com/listen.
Did you know Fast Growing Trees is America's largest and most trusted online nursery with thousands of trees and plants and over 2 million happy customers? Whether you're planting fruit trees, adding privacy, brightening things up with flowers, or bringing in houseplants, Fast Growing Trees has it all. Even better, they can help you find options that are right for your climate, your space, and lifestyle. Click Order Grow. Every plant arrives healthy with the Alive and Thrive guarantee straight to your door. So if you're ready to get planting, this is the moment. Right now, they have great deals on spring planting essentials, up to half off on select plants. And listeners to our show get 20% off their first purchase when using the code WWO at checkout. That's an additional 20% off. Better plants and better growing at fastgrowingtrees.com using the code WWO at checkout. Fastgrowingtrees.com, code WWO. Now's the perfect time to plant. Let's grow together. Use WWO to save today. Offer is valid for a limited time. Terms and conditions apply. Go to growingfasttrees.com for details.
Hey there, stackers. I'm gas go-getter and guy who celebrates getting gas with some ice cream, Joe's mom's neighbor, Doug. You know... I mean, you can't resist.
I see what you did
They've
there.
got those great stores in there with all the good, healthy food.
Gas and ice cream. Sounds like some lactose intolerant going on to me, dude.
Yeah, they sell Imodium too. You know how Oprah likes to give away cars? Today's trivia question is about a German car manufacturer whose company has made lots of Benjamins. Well, back then they were Francs or now probably Deutschmarks. I don't know. But I guess now they're euros. Here was the question. What Mannheim, Germany auto manufacturer patented the gas-powered engine on today's date back in 1886? The answer? It was none other than the great Carl Benz. That's Carl with a K, whose name now, of course, represents half of the Mercedes-Benz name. Hey, Oprah, if for your birthday you'd like to give me a Mercedes-Benz, I'm in. I'll even go on camera for that. And now, back to the guys driving this podcast, Joe and OG.
Oh, how great would that be? You get a Mercedes, and you get a Mercedes.
No, I don't want one.
Oh, but I got to pay the tax on it? I don't want to pay the tax.
Yeah.
That's where they get you, is on the tax.
That's how they get you.
Interesting. Carl Benz.
Yeah. And, you know, Mercedes was actually his daughter. That's where the other half of that came from. He named it after his daughter.
Benz did.
Yeah, I think so. We should look that up, but I think so.
Yes. I'll let you look it up while we get on with the TikTok Minute, Doug. This is the part of the show where we shine the light on a TikTok creator who's doing something brilliant or air quotes brilliant. I love the steam coming out of OG's Oh, geez.
Life was so good for that little bit of time. Do you remember that back a couple of weeks ago?
Remember we had that day?
When all that time people were like, oh, I guess I have to do something else other than sit on my phone.
Oh, you'll love the latest conspiracy theory on time. They're like, they had to change over the servers so that all of the people got together, something involving Mark Zuckerberg, and they were changing over the servers. And so they shut it down long enough so they could do that. They ostensibly said, we're shutting it down. No, we're not. And allowed them now to really, really work against us as if they weren't before. Some people with way too much time on their hands. Ostensibly me.
I was going to say, you were pretty your panties were in a twist when TikTok went down.
It was crazy. Hey, here's somebody who, well, it turns out, OG, she thought she had way more money than she did. At least her kids thought she had way more money than she did.
Okay.
I realized today that my 3-year-old thinks we own the Buffalo Bills. Every time I go to work or my husband goes to work, they always ask, how come you have to go to work and you can't stay home? And of course we say, we got to pay the bills. So today, my husband's at work and I'm at home with the kids, and somebody asked, how come Daddy didn't have off this week? And my 3-year-old said, because he has to pay Josh Allen. I didn't know that's how that worked. Pagulas, I'm coming for your job.
She owns the Buffalo Bills, apparently. Nice. That was hilarious, Jane. Nice work. If you see something either interesting, wild, or, well, to OG's point, some weirdness online.
Some talk.
Yeah. Speaking of some interesting things on social media that may or may not be true, we received a note on Instagram from Matt Julian. Matt found something on Instagram, OG, that, looks pretty legit. This person wrote that you can do remote triaging online as a job. Are you familiar with remote triaging? Listen to this. As a remote triager, an online sales rep, your job is simple. You reply to DMs on behalf of business owners and book sales calls, or you help take those calls. Once a deal's closed, you can make upwards of $250 to $1,000 for every deal. Nice. Beginners are making $3,000 to $10,000 per month, and they work 3 to 4 hours a day.
Sweet.
Yeah. It's good work if you can get it. Thanks, Matt.
Mm-hmm.
It doesn't sound scammy at all to me. Remote triager. Remote triager. So good.
Don't even have to go to medical school.
No.
That's a broken arm.
You don't have to. I got it.
Broken.
Wait a minute. I know what that is.
Next.
I'm exhausted from that.
You definitely have tetanus. That is a nail in your foot. Next.
Wow. I haven't seen goiter in years.
I think you've been bit by a squirrel. So many things. Doug, apparently, speaking of that, you don't need to be a doctor to pontificate about the trivia and where the name Mercedes came from.
No, you can just make it up. And but when I say it, it sounded like I knew what I was talking about,
You
right?
said it with confidence.
I know. That's the key to everything. And I was in the neighborhood, but as it turns out, Mercedes was somebody's daughter, but not Carl Benz's, Carl with a K. There was another guy who way back when, in the early days of Daimler and Maybach, who were building these vehicles, there was a dude named Jelinek who would buy them and then turn them into race cars. And it was his daughter, Mercedes Jelinek, where the name Mercedes came from. So, it's very complicated. There were a bunch of German engineering guys involved, but it was this Jelinek guy's daughter, Emil Jelinek, who was making race cars out of Mercedes.
And imagine she just got her name on a brand forever and ever.
Yeah. And I think she was kind of like the woman who designed the Nike swoosh. I don't think Mercedes
didn't get anything out of it, right?
She got nothing out of it.
How much did the Nike swoosh person get paid? Off the top of my head, I think that was like $80.
Yeah. Somewhere less than 100 for sure. Yeah.
Let's go to something that we do know the answer to, which is
overrated.
We can answer somebody who said, you know what, I better call Saul. C-Hi and OG. This is a part of the show where we help a stacker in need. And this stacker wanted to be anonymous. So let's say his name is OG. What's the name of your favorite wrestler?
Hulk Hogan.
Hulk. His name is Hulk. Hey, Hulk.
Hey, Joe and OG. I'd like to get your opinion. Doug, you can keep your opinion to yourself. I don't trust your decision-making capacity after what I've seen at the Sizzler. So here's my question. At what point do you give up tax optimization for flexibility? I'm a 37-year-old physician with a total household income of about $380,000 a year. I have a 403B and 457B. My wife has a 401k, all of which we max out. We also max an HSA, 2 backdoor Roth IRAs, and fund our kids' 529s up to the state tax deduction limit each year. My employer also graciously puts $40,000 each year into my 403B. All said and done, I can save about $140,000, or about a third of my total compensation, into tax-favored retirement accounts. All accounts have good investment options, and our only debt is a $500,000 mortgage at 2.75%. We currently have about $650,000 saved in pre-tax, $200 in Roth, $30 in HSAs, $30 in taxable, and about $60 in cash for an emergency fund, or opportunity fund, as Joe likes to call it. So my question is, when do I start optimizing for flexibility? I figure at some point I should start putting more money in taxable, but it pains me to pay more in taxes than necessary. My thought is to keep doing what I'm doing for the next 5 to 10 years, then back off on my pre-tax accounts to focus on taxable and paying on the house. What are your thoughts? Also, should I get a shirt that fits me now, or a shirt that I aspire to fit into? Maybe that can be a question for your next Better Call Saul. See hi. Anyway, thanks. See ya.
I mean, I order shrimp one time at the Sizzler, and suddenly my decision-making is called into question.
It's time to reflect on those decisions. Time to reflect, Doug. Hey, Hulk, thanks for the call. I don't know if I can call him
Hogan.
Dr. Hulk to you. Yeah, Dr. Hogan. I would love to have his problem. It's a fantastic problem to have. Doing a great job of saving, able to put a lot of money away. But, OG, it is a great question. When do you look at tax flexibility versus, trying to avoid the tax man as much as possible today?
Well, I think the easiest solution to all of this to kind of keep the contributions the same would be to flip 403B or 401k contributions to Roth. Since you have so much money coming in pre-tax from your employer matching contributions, maybe your spouse has employer matching contributions also, those are going to be pre-tax, and you also have a big pre-tax bucket already. That's kind of the flexibility that I would look at, is just flipping those numbers from all being pre-tax to maybe some of your contributions being Roth. The reality is that at the end of the day, there's no free lunch. If you stop all of your contributions, and let's say you're out there maxing out your 401k right now and you're putting in the 23.5, and you say, well, if I put that in my Roth instead, isn't that better? And it might be better than today, but I do know for a fact that it's going to cost you $6,000 or $7,000 or $8,000 in taxes today. Your tax bill rather is going to go up by a bunch, because you're going to have another $24,000 of taxable income compared to the year prior. Maybe the right idea is to change it over a period of years, right? So make a 5% change every year, or a 10% change in your contribution every year for 10 years to kind of get it up to 100% Roth. There's really no correct answer here. If you're thinking about it from the perspective of, well, I might want to be financially independent early, and I'm concerned about having a bunch of IRA money that I can't touch, the IRS doesn't care when you retire. They just care that you retire. So you can always access your retirement money if you're retired. What they prevent you from doing, or strongly encourage you to not do by penalizing you, is touching your retirement money before you retire. So that's not really a concern that I see it anyway, in terms of early retirement considerations. The other thing to look at also is, you're making $350,000 right now. Is that number likely to stay the same? As time goes on, it'll probably increase depending on your specialty and depending on, just even cost of living changes. But generally speaking, it's going to increase. So, it sounds really grotesque to say, but you might actually be in the lowest tax bracket you're going to ever be in right now. And the right answer is to go after tax today. So there is no correct answer to this. It's just knowing the domino that's going to fall in the tax bucket so that you're prepared to withstand that. The worst that happens is you change it all. You go, we're going to go all 401k right now. We're all going to go Roth, or we're going to put all that 140k or as much as we can into our brokerage account instead. And you're ill prepared for the tax bill that's going to happen because of that. Doesn't make it right or wrong, because you're trying to solve for a problem that we have no idea, or solve for a solution that has an unknowable future, which is, what are the tax rates going to be in the year of your distribution in 2040, whatever, when you decide to take money out. And by the way, how much are you going to take out, and how are you going to start? We just can't answer that. So I think that what you're doing right now is fine. I might if I was going to make a change, I would make the change to be more Roth 401k focused because you have the excess cash flow clearly by saving 150 grand a year. And you're well behind in terms of balance. If you're thinking about it, if balance was a requirement, which it's certainly not, but if you were thinking, I want this to be 50-50, you're never going to catch it because your company's putting 40 grand in and you're behind by 400,000 right now. So it's going to be really hard to catch up. Not that you should. I'm just saying, maybe the first change is allocating more money to Roth 401k contributions in the future. Just kind of drip that in over the next little bit.
How much does he do for that? Just as much as he can stomach? If he's looking at his tax bill, like how much additional tax bill he can stomach?
The reality is that day one is going to be the most painful because you're not used to it. Yeah. That's why, it makes a lot of sense when you're young to set up all those savings and automate all that stuff. You graduate college and you get your first job and it's $60,000 a year. You better be saving 25%, because if you don't save it now, it's going to take you until you make 600,000 to be able to save 25% again. You know what I mean? Like you'll just use it up and you better be Roth because you don't know any better. But now that he knows and he goes, well, my tax bill last year was 100 grand. If I do this, it's going to be 110. My God, that's ridiculous. It's only ridiculous because you know about the 100. If you didn't know about the 100, then 110 is 110. It only matters in the comparison. So honestly, I would probably change it over a period of years between the doctor and his spouse. They've got $47,000 that's going in 401ks right now. Maybe this year you do 20% of that. And then next year you do another 20. And, it takes you 5 years to kind of move into it. You could also get really strategic and say, well, my pay rate went this year from, I went from 380 to 397 in payroll. So I got 17,000 to play with, like you could really
just do the up.
Yeah. Just whatever extra you make net after tax, you allocate to the tax bill to kind of count for it. But it sounds like there's so much extra fluff in the budget that
sure
it's whatever you want to do.
It's going to pay off later though. Dr. Hogan, it will pay off later to get that flexibility that you're looking for. And I also second that emotion, OG, starting earlier, better starting late. And clearly to your point too, he's going to be fine if he just keeps doing what he's doing. Right.
Yeah. I've never talked to anybody that's like, oh God, my life sucks, man. I got 7 million in my IRA. Right. Sucks, bro.
Couldn't do it.
It's just part of the deal.
It's a nice start.
Good job.
Thanks for the question, Dr. Hogan. If you've got a question for us, stackingbenjamins.com/voicemail is the way to get there. And you know what? We reward people that call in with the shirt that Dr. Hogan talked about. And what's cool? We're going to send you a code and you get to decide whether it's aspirational. But I think you should go for the aspirational. I think you should say yes.
The schmedium.
Yep, because he'll also look really ripped in that thing, right? While he's on his journey. I mean, I guess it depends on which way he's going.
Yes. Depends on the aspirations.
Right. If he's building it really, really, really big because he doesn't have the muscles. I don't know.
Going beach body or are we going winter warmth?
Yeah.
Which way you headed, buddy?
Not sure what he's aspiring to. It's all individual goals. stackingbenjamins.com/voicemail gets you there. Let's journey out to our community segment of the show before we say goodbye, which is what we call the back porch. Next Thursday, guys, I will be in Seattle, actually be in Bellevue, right next to Seattle.
Isn't that an insane asylum, Joe?
I will be. Doug's like, it's about time that you figured out. Yeah. stackingbenjamins.com/meetup Thursday night, 6:30. I will be in Bellevue, which is the same place where I will be speaking on Saturday. Well, I'm going to be in a different place because we're going to be at a place where there's beer, Tapster Bellevue. This is one of those cool places, guys, where they have serve yourself beers. That could be dangerous. Like you walk up to the tap and you've got a little QR code. And
I just learned about these. There's one of those in Michigan here that I just learned about. And yeah, you have to scan your QR code every time.
Scan your code. Yeah.
Like, is there somebody watching you or could you just sort of like fake scan it and then pour?
I don't know. But if there's a system, Doug will find a way. It'll be
free beer.
just what we want to emphasize. Cheating the system. I can't wait. I've never been to a place that has pour yourself beer. So people can make some fun videos of Joe, I'm sure. Dancing on the tables, whatever it might be. stackingbenjamins.com/meetup.
God, you don't want to see Joe dance.
We're gonna
really don't want that.
Every time we play that pre-video on YouTube. Oh my God. Joe dancing. Not great. You guys are going to be at Tahoe. We don't have the place yet, but you will be there near the end of February.
I think we do. We're going to be there on the 19th, right? Wednesday. And right now it looks like we're going to be at McPee's Tap House.
6 to 8.
6 to 8.
BYOB.
McPee's Tap House, 6 to 8. Will they let you BYOB? Everybody's walking in with their own alcohol.
It's Nevada. I mean, everything's legal in Nevada. Yeah, bring your own.
Just bring it on in.
Wait, we're going to Nevada? We have a new place to meet. New place. I'll talk to you after.
StackingBenjamins.com/meetup. It's going to be fun. All right. That's going to do it for today. Doug, you've got it from here, man. What should we have learned on today's show?
Oh, actually, it is on the corner. McPee's Tap House is on the state line. It's probably 40 feet from Nevada. We're going to be in California. Dang it. I don't let you do anything in California. But here's what else we should have learned today. First, take some advice from our headline. Using a target date fund, set up your own target date fund. You'll avoid fees, better understand what you're doing, and avoid losing out on returns because someone arbitrarily decided to drop the stocks in your portfolio. Second, bills? Yeah, I got bills. Just not the Buffalo Bills. But hey, I'm in Josh Allen. If you want help with how to spend that paycheck, we're here for you, buddy. But the big lesson? Don't ask Joe's mom about a round of hot chocolate because she'll start singing that song from Polar Express. You know, the one where it's like, never, ever let it cool. Keep it cooking in the pot. Soon you got hot chocolate. God, that just gets in your head.
Hot.
Oh, God, now it's in my head. Son of a... This show is the property of SB Podcasts, LLC, copyright 2025, and is created by Joe Saul-Seeheim. Joe gets help from a few of our neighborhood friends. You'll find out about our awesome team at stackingbenjamins.com, along with the show notes and how you can find us on YouTube and all the usual social media spots. Come say hello. Oh yeah, and before I go, not only should you not take advice from these nerds, don't take advice from people you don't know. This show is for entertainment purposes only. Before making any financial decisions, speak with a real financial advisor. I'm Joe's mom's neighbor, Doug, and we'll see you next time back here at the Stacking Benjamins Show.
While I was online, I saw this fantastic tale that I'd like to play for you.
Okay, quick walk of shame story time. So I used to live in the DC area, and at the time I was dating this man who lived in a very nice condo building in Logan Circle. One night after many beveraginos, I find myself waking up in his apartment, 6 a.m., still drunk. I carefully peel back on my leather pants, and I tiptoe out of there to get to my car that is parked in the residence garage below the condo. As I'm getting into the elevator, his neighbor catches the doors just in time to join me for the ride. His neighbor? Supreme Court Justice Sotomayor. I look at her, and I bio-breathe Jack Daniels onto her as I say, "Good morning." She looks me up and down. And because I can't just stay quiet, no, I have to say something. I look at her and I say, "Judging started a little early this morning, huh?" She says nothing. The doors open to find 2 U.S. Marshals there to greet her, to assist her, escort her to her armored vehicle, to take her to her job at the Supreme Court. So, Sonia, if you're seeing this, girl, remember me in the leather pants? Save TikTok for me, for us. I'm so sorry I said that. I'm so sorry.
I think what you miss in the audio version of that is she sort of demonstrates the way that Sotomayor scanned her up and down with disgust.
I don't know, man. You couldn't hear that. I heard that pretty loud and clear.
Judging starting a little early, huh?
I love those moments, though, when you say something and you're like, oh, put it back in. Put it back in, please. I did that a long time ago at a Detroit Pistons basketball game.
Oh, I had one there too that I regret. What was yours? I'm not telling mine, but what was yours?
This is back when Grant Hill played for the Pistons, and I had a ton to drink, and he had a new pair of shoes out called the Fila Hills. And they were had this weird, they were like white shoes with this blue stripe that went right up the middle. And after halftime, my buddy and we were sitting courtside, by the way. We were in those folding chairs on the
scoreboard.
Yes. And I was sitting in the second row, and I'm sure we were just getting louder, more obnoxious. But Grant Hill would inbounds right in front of us when they do it from about the free throw line-ish. That was where we were at. And I remember he comes over and he stands right in front of us. And after he inbounds, I'm like, oh God, those shoes are so ugly. Okay. I decided I hate the shoes. And then I was trying to crack a joke and I said, but I wonder if he gets paid. You think he gets paid to wear those? And the dude sitting right in front of me turns around, his face is beet red. He shoves a card in my face and goes, hell yeah, he does a lot. And call me sometime and I'll tell you, it's the Fila rep. Right in front of me.
You were giving him free market research is all you were doing, Joe. That doesn't sound that bad to me.
But you know what's funny was that then he turned around later. He goes, very seriously, I don't give a what old men like you think. He goes, you're not my target market. Oh. He was not happy.
Wow. That took him a long time to think of that comeback though. He doesn't get any points for that.
No, I just thought he was a jerk. Fila guy, you were a jerk.
Bet he's listening.
The Supreme Court Justice. Maybe doing a little judging.
Hey, you know what? That's what we need. If you're a famous person listening to us, let us know. I mean, it'd be great if you did it in the basement, but just so we know we've got some firepower listening to us.
Have you heard that story? Peter Frampton told the story on.
No, I haven't heard it.
He listens to us?
Peter Frampton told the story on I believe it was Howard Stern, about how he was in the elevator on his way to go get ready for his gig. And most people, even from the 70s, who would even know who Peter Frampton is, don't realize that he is now bald versus that long mane of hair that he had. Yeah. And so he was just trying to make conversation, people in the elevator, and they're like, oh, we're going to see this one washed up guy. Like they were totally ripping him. He's like, imagine what happened when I come out and I'm the washed up guy that they were going to see. They're like, yeah, we got free tickets. Somebody offered us. We really don't want to go, but didn't have anything else going on. So
brutal.
Not good.
Nice.
I'd love to hear your foot in the mouth stories. Like what's something that you said, Stackers? Call us, either leave it on voicemail for the show or share it in the basement. But we prefer you to leave it on a voicemail so we can hear your Supreme Court Justice story.
Yeah, we need a lot more audience participation that we can put on an episode.
Bring it.
Yeah.
Bring it, Stackers.